there is a number that most people have completely stopped paying attention to. It sits quietly on financial terminals. It blinks on commodity screens. It barely makes the evening news. And yet, right now, that number is doing something it has only done a handful of times in modern economic history. Gold is rising, not slowly, not gradually. It is climbing with the kind of quiet, deliberate momentum that historically precedes something large, something uncomfortable. And here is the part that should make you stop. Gold is not rising because the economy is collapsing. It is not rising because of panic. It is rising while stock markets are near all-time highs, while unemployment is relatively contained, while central banks keep projecting confidence. Gold rising during chaos makes sense. Gold rising while everything looks fine? That is the signal worth understanding. Because the last time gold behaved like this, what came after was not minor. What gold actually is. Before we get into what is happening, we need to strip gold down to its actual function, not the romantic version, not the shiny metal that kings fought over, the financial version. Gold does not pay dividends. It does not generate cash flow. It does not grow a business or fund innovation. If you locked gold in a vault for a decade and came back, you would find the exact same amount of gold you left. By conventional financial logic, gold should be irrelevant. And yet, every time the global financial system starts to show cracks, real cracks, not surface noise, money flows into gold. Not because gold fixes anything, but because gold has one property that paper money, digital assets, and government bonds do not. It cannot be printed. That distinction is the entire story. The moment you understand that, you understand why gold's price is not just a commodity signal, it is a trust signal. When gold rises, it is not saying the economy is doing well. It is saying that large pools of sophisticated capital are quietly reducing their confidence in something else. The question is, in what? The numbers behind the move. Let us look at what is actually happening. Gold has moved from roughly $1,800 per ounce in early 2023 to pushing past $3,000 in 2025. That is not a blip. That is not a quarterly correction. That is a sustained, structural climb of more than 65% across 2 years. To put that into context, the average annual return on the S&P 500, the benchmark for global equity performance, is roughly 10% over the long run. Gold just ran at 3 times that pace, during a period when stocks were also rising. When two assets that historically move in opposite directions both rise simultaneously, that is unusual. When gold outpaces equities during an equity bull market, that is the financial equivalent of a smoke detector going off in a building where no one can smell anything burning yet. It demands an explanation. And the explanation is not one thing. It is several forces converging at the same moment. The forces driving gold right now. Force number 1. Central bank buying. This is the one that gets almost no attention in mainstream financial coverage, and it is arguably the most important. Over the past 3 years, central banks globally have been accumulating gold at a pace not seen since the early 1970s. China, India, Russia, Poland, Turkey, Singapore. Country after country that once held the majority of its reserves in US dollars has been quietly, deliberately, converting a portion of those dollars into gold. These are not retail investors chasing a trend. These are sovereign institutions whose entire mandate is long-term financial stability. When a central bank sells dollars to buy gold, it is making an institutional statement about what it trusts more over the next decade. Think about what that means. The very entities that hold the architecture of global finance together are hedging against that architecture. Force number 2, the dollar's position. Since the end of World War II, the US dollar has functioned as the world's reserve currency. Oil is priced in dollars. Trade is settled in dollars. When countries need a safe place to park wealth, They buy U.S. Treasury bonds, which are denominated in dollars. That system has worked because it was backed by trust. Trust in American institutions, trust in the rule of law, trust in the reliability of dollar-denominated debt. That trust is not gone. But it is no longer automatic. Between 2020 and 2022, the U.S. government and Federal Reserve injected more than $6 trillion into the economy. That was not emergency spending, financed by savings or growth. It was money that did not previously exist, created to meet an immediate crisis. The total U.S. dollar money supply effectively increased by roughly 40% in 2 years. When you expand the supply of any asset by 40% in 24 months, basic economics says its value per unit should fall. And while inflation did rise sharply, the highest in 4 decades, it has since moderated. But moderated is not the same as corrected. The dollars still exist. The debt is still there. Countries that hold enormous reserves of U.S. Treasury bonds are doing the math on this, and some of them are converting their conclusions into gold. Force number 3, geopolitical fracturing. This one is subtler but equally important. Gold is stateless. It does not belong to any government. It cannot be frozen by sanctions. It cannot be seized by a competing superpower. It does not require trust in another nation's legal system or political stability. In 2022, following the invasion of Ukraine, the United States and its allies froze approximately $300 billion in Russian central bank assets. Those assets, denominated largely in euros and dollars, became inaccessible overnight through a political decision. Every central bank on earth watched that. Every country that holds its reserves in foreign currencies now has a data point it did not have before. Your reserves can be functionally confiscated if the geopolitical winds shift. Gold, held domestically, cannot. The result was an acceleration in central bank gold purchases that has not slowed. The debt mathematics. Here is the part of this story that almost no financial commentary actually confronts directly. The United States currently carries a national debt of more than $34 trillion. The annual interest payments on that debt, at current rates, now exceed $1 trillion per year. That is more than the entire U.S. defense budget, more than Medicare, more than Medicaid. And here is the structural problem. That number is not going to fall. Even if the United States runs a balanced budget going forward, spending exactly what it collects in taxes, not a dollar more, it still has to roll over existing debt as it matures. Debt issued at near zero interest rates during 2020 and 2021 is gradually being replaced by debt issued at 4, 5, or 6% interest rates. Each refinancing cycle locks in higher costs. The Congressional Budget Office projects that within a decade, debt service alone could consume roughly 20 cents of every dollar the U.S. government collects in revenue. There are only a few ways out of a debt spiral of this scale. You can grow your way out if GDP grows faster than debt. The ratio eventually improves. You can cut spending dramatically, politically almost impossible in a democracy with an aging population demanding health care and retirement benefits. Or you can inflate your way out, allowing inflation to erode the real value of the debt over time. Historically, governments under debt pressure choose the third option, not explicitly, not with press conferences. They simply allow inflation to run slightly hot, keep interest rates slightly low relative to inflation, and watch the real burden of debt quietly diminish over years. This is called financial repression, and it is devastating for anyone holding cash or fixed-rate bonds. It is excellent for anyone holding gold. Gold does not care about inflation because gold cannot be diluted. When a government inflates its currency, gold does not lose purchasing power. It simply prices itself in more units of that currency. The metal stays the same. The number next to it gets larger. Sophisticated investors are positioning for this possibility before it is confirmed. That is what the current gold price reflects, what history says. Let's go back to the data. In 1971, Richard Nixon ended the gold standard. Gold, which had been fixed at $35 per ounce, was freed to trade at market prices. Within a decade, it had climbed to $850 per ounce, a gain of more than 2,000%. The context: a decade of deficit spending, the Vietnam War, rising inflation, a weakening dollar. Sound familiar? In 2000, gold was trading near $250 per ounce. Most analysts considered it irrelevant, a relic of a pre-digital financial world. By 2011, it had climbed past $1,900 per ounce. That 8-year journey corresponded almost exactly with the collapse of the dot-com bubble, the 2008 financial crisis, the bailouts, the quantitative easing programs, and the first era of zero-interest rate policy. Gold did not predict those events. It reflected the accumulating tension beneath the surface, the growing distance between what the financial system was projecting and what the underlying mathematics actually supported. We are in a structurally similar moment. The surface looks calm. The numbers underneath are not. The counterargument: any honest analysis has to confront the case against gold. And there is a serious one. Gold has had long, brutal periods of underperformance. Between 1,980 and 2,000, it lost nearly 70% of its inflation-adjusted value, while stock markets delivered extraordinary returns. People who bought at the 1,980 peak waited more than 2 decades just to break even in real terms. Gold is also notoriously difficult to value. With a stock, you can model cash flows, earnings, and dividends. Gold produces nothing. Its price is entirely driven by psychology, scarcity, and competing narratives about what the future holds. Critics argue that the current move is driven by momentum and retail speculation, not genuine institutional concern. They point to the fact that U.S. stocks remain strong, that inflation has moderated significantly, and that the dollar, while facing headwinds, remains the dominant global reserve currency with no credible challenger in sight. These are valid points. But here is what makes this moment different from previous gold manias. The buying is not retail-led, it is central bank-led. Sovereign wealth funds and institutional buyers with 2-0-year time horizons do not chase momentum. They accumulate positions when they have reached internal conclusions about structural risk. The scale and consistency of central bank gold buying over the past 3 years suggests those conclusions have already been reached in certain quarters. You can dismiss individual investors as emotional. It is harder to dismiss the Reserve Bank of China, the Reserve Bank of India, and the National Bank of Poland simultaneously making the same decision. What this means in practice. Here is the honest translation of everything we have covered. Gold at $3,000 is not telling you the economy is about to collapse tomorrow. Markets rarely work on that timeline. What it is telling you is that a significant portion of sophisticated, long-horizon capital has concluded that the next decade will involve more monetary instability, more debt pressure, and more geopolitical friction than the previous decade. That is a different kind of signal than a recession forecast. Recession signals are about the next 12 to 18 months. Gold's current behavior is a multi-year statement about the structural direction of things. For someone trying to understand what this means personally, the relevant questions are straightforward. How much of your wealth is denominated in a single currency? How exposed are you to fixed-rate instruments in an environment where inflation could resurface? What is your current buffer against a decade of low real returns on bonds, which would occur if governments deliberately keep interest rates below inflation? None of this requires panic. None of it requires certainty about what happens next. But it does require honesty about what the signal is saying. The argument for ignoring gold's current behavior is essentially an argument that the debt dynamics are manageable, that central banks have it under control, and that the global financial architecture built over the past 50 years will continue functioning as designed. That may well be true. But the people buying gold at $3,000 an ounce are not convinced. And they are not small people. There is a version of the future where gold peaks here, reverses, and spends another decade languishing, while stocks deliver stellar returns and central bank concerns prove overblown. That outcome is entirely possible. There is another version, where what we are seeing now is what the early stages of a major monetary realignment look like. Slow, quiet, easy to dismiss, until it is impossible to ignore. Gold has survived every currency that has ever tried to replace it. Every empire that issued paper money eventually tested the limits of that money. Some recovered, some did not. The metal itself has no opinion on which version comes next. It just sits there, unchanging, while everything around it fluctuates. But for the first time in a while, the price is high enough, and the buyers serious enough, that it is worth asking the uncomfortable question it is raising. What do they know that the headlines are not telling you?